Section 1. Hook. I want to start with a question that probably keeps more people up at night than they would like to admit. Am I making the biggest financial mistake of my life by renting? Or am I making the biggest financial mistake of my life by buying right now? Because here is the reality of 2026. Mortgage rates sit at 6.3%. The median home price in America is $436,000. The average monthly payment on that home, principal, interest, taxes, insurance, and PME, is close to $3,400. And comparable homes in many markets rent for $1,800 to $2,300. That is a $1,000 to $1,600 per month difference for the same house. That gap is why millions of people are paralyzed right now, stuck between the fear of renting forever and the fear of buying into a market that does not seem to make financial sense. Today, we are going to resolve that paralysis. Not with opinions, with the actual math. Side by side, honest about what each path costs, what each path builds, and the single number that tells you which choice makes more sense in your specific situation. Let's get into it. Section 2. The myth we need to kill first. Before any numbers, we have to address the phrase that has distorted this conversation for decades. Renting is throwing money away. It is not. And I say that as someone who believes home ownership is genuinely one of the most powerful wealth-building tools available to ordinary Americans. The phrase is still wrong. When you rent, you pay for housing. You receive housing. That is a transaction with real value. You are also paying for flexibility, zero maintenance liability, no property tax burden, no repair bills, and no exposure to a falling market. None of that is throwing money away. Now here is the counterpoint, the other side of this argument, that renting is always smarter because you can invest the down payment and monthly savings, is also wrong for most people. The math works on paper. In practice, most renters do not actually invest the difference. They spend it. And the wealth data across millions of American households reflects that reality. The median net worth of American homeowners is approximately $396,000. The median net worth of renters is $10,400. That is a gap of nearly 40 times. It does not exist because buying is always mathematically better. It exists because home ownership forces you to build equity, whether you are paying attention or not. Every mortgage payment builds your net worth automatically. Most renters cannot say the same about their spending habits, so before we run the math, understand this: neither renting nor buying is universally right. The right answer depends entirely on your specific numbers, your local market, and how long you plan to stay. Let's build that picture now. Section 3. The real numbers, side by side. What buying actually costs per month. Let's use a $400,000 home. 10% down means $40,000 out of pocket, plus closing costs of roughly $12,000, so $52,000 total up front before you own a single square foot. The loan is $360,000 at 6.3% over 30 years. Principal and interest, $2,233 per month. Add property taxes at the national average of about 1.1% of value, $367 per month. Homeowner's insurance, $233 per month. Me, because you put less than 20% down, roughly $210 per month. That continues for around 10 years. And maintenance and repairs, which every financial planner estimates at 1% of home value per year, $333 per month set aside. Total true monthly cost of homeownership, $3,376. Not the mortgage, the full picture. What renting actually costs per month. A comparable home in the same market rents for approximately $2,100 to $2,300. We will use $2,200. No property tax. No maintenance bills. No PME. No HO if it is a single-family home. No closing costs going in. No agent commissions going out. Month 1 gap, $376 minus $2,200 equals $1,176 per month more for the buyer. That is $14,112 per year more in year one. The renter has a meaningful cost advantage right now. Why that gap shrinks and eventually flips. Here is the part that changes the entire story. Rents do not stay flat. The national average rent increase in the United States is approximately 4 to 5% per year. The renter paying $2,200 today is paying roughly $2,640 by year 3. By year 6, they are likely paying close to $3,100. The homeowner's principal and interest payment is $2,233 today. It is $2,233 in year 5. It is $2,233 in year 15. Permanently fixed. The only adjustments are taxes and insurance, which are far smaller and more predictable than open market rent increases. So the renter's $1,176 monthly cost advantage in year 1 becomes approximately $700 by year 3 and $200 by year 6. At some point in most markets, the buyer's total monthly cost falls below the renter's rising rent and then stays there. The national average break-even point in 2026 is approximately 5 years and 8 months. In cheap Midwest markets, it can be as fast as 3 years. In expensive coastal cities, it can stretch to 10 or 12. This is the math most people never run. They compare month 1 and stop there. Month 1 is not the decision. The 5-year picture is the decision. Section 4. The 5% Rule. Your quick answer. Let me give you the fastest way to test whether buying makes financial sense in your specific market right now. It takes about 30 seconds, and it is more useful than most conversations about this topic. It is called the 5% Rule. Take the purchase price of the home you are considering. Multiply it by 5%. Divide by 12. That number is your monthly benchmark. If you can rent a comparable home for less than that number, renting likely wins on a monthly basis in that market. If comparable rent is higher than that number, buying is likely the better financial move. Let's apply it right now. A $400,000 home. $400,000 multiplied by 5% equals $20,000. Divided by 12 equals $1,667 per month. If a comparable home in that market rents for $1,500, renting is clearly cheaper. The 5% rule says rent. If comparable rent is $2,200, buying is the stronger monthly choice. The 5% rule says buy. This rule accounts for the 3 main unrecoverable costs of ownership: property taxes, maintenance and insurance, and the opportunity cost of your down payment capital, compressed into one usable number. It does not account for appreciation or rent increases over time, so it is a starting point, not a final answer. But it is the most honest and fastest first test available. Run this rule on any home you are seriously thinking about. Write the number down. Then find the actual rent for a comparable home in that neighborhood. The comparison will tell you more than any general debate ever could. Section 5. 3 questions that determine your answer. The 5% rule tells you about your market. These 3 questions tell you about your life. Both matter. Here they are. Question 1. How long are you staying? This is the single most important variable in the entire decision. If you are not confident you will be in the same city for at least 5 years, renting is almost certainly the correct financial choice regardless of what the math says about monthly costs. Here is why. When you buy a home, you pay closing costs of 2 to 5% on the way in, and agent commissions plus fees of 5 to 6% on the way out when you sell. On a $400,000 home, that is $28,000 to $44,000 in pure transaction costs that evaporate the moment you sell. If you have not stayed long enough for appreciation and equity growth to absorb those costs, you lose money, guaranteed. The 5-year rule is not arbitrary. It reflects the real math of how long it takes for equity and appreciation to overcome the cost of buying and selling. If your timeline is shorter than 5 years, do not buy. Keep renting. Invest the difference if you can. Come back to this decision when your timeline is clearer. Question 2. Is your financial foundation ready? A mortgage approval letter does not mean you are financially ready to buy a home. Those are two completely different things. Before home ownership belongs in your plan, you need 3 things in place. 0 high-interest consumer debt. Because credit card and personal loan payments reduce your buying power and leave no financial buffer for the unexpected costs that hit every new homeowner in year 1. A fully funded emergency fund of 3 to 6 months of expenses sitting in a separate savings account because vac systems break, plumbing leaks, and appliances fail without asking permission. And a down payment that does not empty your savings account because the first year of home ownership almost always costs more than buyers expect. And arriving at closing with nothing in reserve is one of the most reliable ways to turn a major asset into a major source of financial stress. If any of those 3 foundations are missing, the financially correct move is to keep renting while you build them. The house will still be there in 12 months. Your financial security is more important than the timeline. Question 3. What does your local market actually look like? National data gives you context. Your local market gives you the answer. According to Empower's 2026 analysis of the 50 largest U.S. metro areas, buying is currently cheaper on a monthly basis in 23 of them, and renting is cheaper in the other 27. The split is almost exactly even, and it varies enormously by city. In markets like Cleveland, Memphis, Kansas City, and Indianapolis, price-to-rent ratios remain low, and buying is clearly advantageous. In San Francisco, New York, Seattle, Los Angeles, and Miami, price-to-rent ratios are so high that renting wins strongly on monthly cost, and the break-even timeline stretches to a decade or more. The rent versus buy decision in your city is not the same as the rent versus buy decision nationally. Look up the median home price and the average rent for comparable homes in your specific neighborhood. Run the 5% rule. The answer is local, not national. Section 6. The Verdict Plus Call to Action. Let me give you the honest verdict. In most American markets, if you are staying for 5 or more years, have your financial foundation fully in place, and the 5% rule shows that comparable rents are higher than your benchmark number, buying is the stronger long-term financial decision. It forces equity growth automatically, protects you from rising rents with a fixed payment, and in the vast majority of U.S. markets over any significant time horizon, it builds more wealth than renting and hoping you have the discipline to invest the difference. If you are staying for less than 5 years, carry significant consumer debt, do not yet have a complete emergency fund, or your local market's rents are dramatically lower than the 5% benchmark, renting is the smarter choice right now. Not forever. Right now. There is no shame in that. The people who get hurt in housing are not the ones who chose to rent. They are the ones who bought before they were ready, because they felt cultural pressure to own. Here is your one action from this video. Pull up a home in your target neighborhood. Multiply the price by 5%. Divide by 12. Write that number down. Then look up what a comparable home in the same area actually rents for. Compare them. Then answer this honestly. How long am I actually planning to stay? Those 2 pieces of information will tell you more about the right decision for your specific life than any argument about renting versus buying ever will. Drop a comment below. Are you currently renting or owning? And which direction are you leaning? I read every single comment, and I want to know where this community stands. If this helped you think more clearly about one of the biggest financial decisions most people ever face, share it with someone who needs it. Subscribe for a new video every week, and I will see you in the next one.